active fund managers keep underperforming the broader market. Now, that's a problem for you if you've got a pension, if you've got a job, if you plan to retire. Basically, it's a problem for everybody. How do we measure the causes of success and successful fund managers? Well, hard work and skill are part of it. And of course, luck plays a part as well. But none of these will be any more than excuses if a fund manager tells you that your pension's pretty much at the same levels it was 10 years ago, or if it tracked the FTSE 100 where it was 20 odd years ago. So when we consider long-time performance of active fund managers in the UK and the US over the last decade, a worrying trend emerges. According to S&P Global's indices versus active scorecard, that's SPIVA or SPIVA scorecard, most equity fund managers fail to beat the market. And that's pretty worrying because it suggests you ought to be just having an index tracker, something passive. And this is not a blip. With the odd exception, what you'll find is that most of the last 100 years, or certainly since records have been kept since the 50s and 60s, active fund managers have not managed to outperform the broader index over any prolonged period of time. And those that have been the odd exception. Okay, this has pretty much been the state of play, certainly since the SPIVA scorecards since 2002. So let's look at active fund managers' poor performance. I want you to consider this. The last SPIVA scorecard showed that 70% of UK equity fund managers underperformed the S&P United Kingdom index over the last decade. That's 70%. In other words, the chances were you were with one of those. In the US market, the picture's even bleaker. Go Britain. You're not as bad as the Americans. 87% of all active funds in the US underperformed their benchmark between 2005 and 2020. During the COVID pandemic and the crash that followed and the early stages of the recovery, well, things weren't getting much better. According to research published by the University of Chicago, almost 3 in every 4 active funds underperformed the S&P 500. And don't forget, they get paid whether they perform or not. They're going to charge you even for losing you money. I can't think of many industries where you get charged if somebody loses you money, puts you in a worse position than you were in when you first came to them. I mean, I don't know, maybe divorce lawyers. This sustained underperformance is a worry for pension investing fund managers. When discussing active versus passive funds, the common refrain is that active funds are perfectly positioned to take advantage of the market in times of significant volatility. However, these figures blow that argument out of the water. Call me a bit old-fashioned, but if the entire premise for active funds is that they outperform passive funds, I'd expect that to happen more than half the time. The reasons why active fund managers are failing are themselves very telling. While on the one hand, these poor results are shocking, on the other, it's not entirely surprising. There are clear reasons for the poor performance of active funds. And I've detailed some of these in my many books over the last 20 odd years. In fact, one of the economists whose research I would repeat very often in my Financial Times columns went on to win the Nobel Prize in Economics. I'm certainly good at picking economists, and that's Eugene Fama. Since the 1960s, the financial markets have undergone a process of professionalism that has resulted in a hyper-educated, hyper-competitive industry. Portfolio management is a zero-sum game that requires fund managers to outkill other fund managers to make a profit. The result, your average active fund manager doesn't have an edge in the market. In a less professional, less informed market, active fund managers were able to triumph. But now, as evidenced by the SPIVA scorecards, being one of the 15 to 25% that outperforms passive funds is increasingly tough. Long-term problems add to this. there are drawbacks to active funds that limit how conducive they are to the ups and downs of long-term success. Long-term stock market success often requires the will to hold on to a poorly performing but high potential stock in the short term. However, it's easy to lose investor confidence or your fund manager job during these downswings. So there's a strong impulse to do something, and usually that entails getting out of those losing investments, which may well turn out to have been better over the longer term. Additionally, as pointed out by the research, funds that do outperform their benchmark over 15 years spend 60 to 80% of that time underperforming. So yes, the tortoise wins, but he's lagging behind for 60 to 80% of the race. Who's going to stick with the tortoise like that? And that's the problem. Private investors can't tell the difference whether it's a tortoise that's going to eventually win or just a loser. These statistics require an iron will, of course, and a very understanding group of investors. Well, the brokers are throwing lots of fund managers at you. They want you to keep switching and switching horses. After all, the chances in any event are that you're on the wrong horse or the wrong tortoise. I say all this not to make it seem as if active fund managers are buffoons who are so incompetent that they're failing to beat the market, although that's an opinion held by researchers like Cass Business School's David Blake. On the contrary, these are smart people stuck inside a tough environment. Imagine your employer has trillions to deploy. Well, they can't give you all that money because if they do, your fund would be huge and you could hardly buy any companies without taking them over wholesale. So they divide it by geography and style. So they have a UK growth fund or a US income fund or a Far Eastern dividend fund. That means you're selecting from a very narrow gene pool. No wonder it's hard for you to beat any index, given the small number of stocks you're asked to pick from. Well, that's a fund manager's problem. Why should it become your problem? Anyway, whatever the understandable causes, their suitability for good pension investing must be called into question. Let's look at how active fund managers mitigate risk, though. Another explanation for the chronic underperformance is detailed in an article, Rob Isbit's excellent Forbes column. He speculates that the real reason active fund managers can't outperform the S&P 500 is that, one, they're not trying to, and two, if they did, they'd be out of business. Let's see what Isbit's saying. What he's saying is that risk management is the main reason for active funds underperformance and makes the point that active fund managers are averse to the exposure of taking a position of the entire index. Whilst this is an interesting point, he admits that indexing is cheaper and has performed well over the last 15 years. Other factors for underperformance? Well, some of the other factors that affect active fund performance are fees, of course, and taxes. Active funds need time in the market to turn a profit. Buying and selling incurs transaction costs. They have a motivation because of their monthly reporting to keep churning. You can't say, I'm going to hold these stocks for 15 years and still expect nobody to raise an eyebrow and you still get paid if you're lagging the rest of the market for 12 of those 15 years. And not only that, a fund manager's job is actually not to get you a return, it's to retain you as a client. So they'll say they need you to be invested for 5 years in their fund, and during that time, they've got to make sure they don't lose you money. Whereas if you don't want to lose money, put it in a bank account. What they're trying to do and supposed to be doing is getting you a return, but they're not trying that at all, and that's become part of the problem. So what might be the answer, might I say? Well, for me, I think it's people either to look at index funds or to be better educated on how SIPPs and ISAs work. And that would then give you the opportunity to at least know where your money's going and why it's underperforming. Okay, that would quite possibly give you an edge. This is all part of my campaign for $1million.com, where I want to teach people how to be better investors. I put a lot more data and free information, including free downloadable copies of some of my books, through that URL. So it's campaignforamillion.com, and I hope you'll become at least a better informed investor, knowing the right questions to ask a fund manager, and for a start, knowing what that fund manager who's investing your pension monies has actually invested in. They're obliged to tell you. And you might think you've got great coverage in certain sectors, geographies, or even stocks, like, I don't know, an Amazon or a Microsoft. When you discover that you've got 5 funds and each fund holds 50 stocks, and therefore you've only got 1/250th of your money in the stock you really wanted to have, maybe 5% of your capital or 3% of your capital, you'll also see why you've been underperforming. It's having the knowledge and confidence to ask the right questions. Certainly don't assume fund managers are as expert as they appear. Very often, it's the regular investor who has the ability to say to a fund manager, "You're not wearing any clothes and you're the wrong type of turtle." Good luck.